In recent weeks, we've been hearing about all of the craziness in terms of the bank collapse, and then that set off a series of headlines that were doom and gloom, saying, is the economy crashing? Is the real estate market going to crash? So much is happening. And so that actually sparked an idea for me in terms of, I figured, what is the best thing I can do? The headlines are going to say one thing, but those of us who are actually within the real estate world, we're seeing things that a lot of times are contrary to what that fear mongering is that's happening in the media. And so I decided to reach out to all of my preferred lending partners and wanted to sit down and have conversations with each of them about various aspects of the mortgage world, what people need to know, in hopes of bringing you guys more value, more educational content. And so, as you may have seen last week, I sat down with Halstead Warren, where we talked mostly about first-time home buyers. But in this week's episode, I'm sitting down and talking with Austin Barnard. Now, he and I talked more about the banking, what happened there, what it caused to happen in the mortgage world, and then what he's predicting for the rest of the year. So you're about to see that conversation. Now, if you have any questions, both of our contact information is below, but without further ado, here is my conversation with Austin. All right, so joining me today is Austin with First Community Mortgage. Austin, you are one of our preferred lending partners. And so I just would love to get your take. I know that we have seen a lot happen in recent weeks. We had Silicon Valley go under the bank. Now we're fully moving into our spring market. And so we're seeing interest rates make some moves. And so whereas a couple of years ago, we had a really good idea of what, the next several months and what the, rest of the year would look like. And now it's just a little bit different. And so I would love to get your take on just what you're seeing currently in the market here in, April of 2023, and just how you've seen the mortgage industry respond to the news of the bank collapse a few weeks ago versus what things are doing now.
Yeah, absolutely. Well, first of all, thanks for having me. I'm glad to be here. Glad to be a part of it. This is exciting.
Absolutely.
Well, I would say from my perspective, I think the housing market in general is getting into that hot season, that spring season. Again, kind of full transparency, like right now, my team and I will have one of the biggest months we've ever had in about 3.5 years, which is a great correlation to what we're kind of seeing, right? So, that wouldn't be happening if the market was going to, the worst place ever, which some people have that reputation. Things are still rocking and rolling. There's always the ebbs and flows in the mortgage world, in the real estate market. That's just to be expected. To give you a little bit of context there, mortgage applications were actually down 3.5% last week as opposed to the week prior. Biggest thing to note there is that's not taking into consideration cash. So could have been more cash buyers. We don't really know. But just mortgage applications were down a little bit.
Do you know if that's responding to anything or, it could just be what it is?
My guess is it probably kind of just is what it is. I mean, to be honest, I would think that the week prior was positive. We were down 3.5% last week. My estimate would be this week we're going to go back up, just because I feel like things have been pretty busy. So again, I think it's just that constant ebbs and flows of whenever something reports and then it shows in that report. That's kind of how I think that goes. But yeah, I mean, interest rates are I'm going to say kind of all over the place. I think a year ago we would be very good at predicting where we're going to see next month or the month after that. Right now it's kind of like a catch-22. I like to say, every week I'm going to give you probably a little bit of a different answer on what I think is going to happen in the future. But I think there's a lot of hope for the future. And I say that because the Federal Reserve is already getting to be a little bit more conservative on what they're doing from an economic standpoint, which obviously correlates to mortgage rates. So you have that piece kind of in our favor. The other thing too is inflation. So mortgage-backed securities or interest rates are very heavily driven by inflation. And up to this point, the year-over-year data that we've seen has been, I'm going to say, relatively flat. We've seen some decrease in inflation as we get into 2023. But as we progress through the year, that spread's going to get even larger. And so we're going to really start seeing that improvement. All the work the Fed has done with those rate hikes is really going to show in the coming months. It's very, like, I'm going to call it retroactive. And so once we see that, I think mortgage-backed securities and interest rates will really start to kind of taper down. Just a guess. Again, every lender in America is probably going to tell you something a little different.
Hang on, say that again.
My guess is that we'll probably see rates
Hang
in
on.
the.
It did this like weird jump. I don't know if that was maybe just on my end, but if you could say the last part again, just so that we have it, just in terms of what your guess is.
Yeah. Okay. Yeah. So every lender is going to say something a little different, but my guess for interest rates moving forward is, I think once we get towards the end of this year, we're going to see rates somewhere in that, mid to low 5 range. Then I think in about 12 months or so, we will get what I'm going to consider that sweet spot of the, we'll say high 4 to maybe mid 4 range. And I do emphasize sweet spot. I think that's very important, that I think a lot of buyers and people need to understand. The land of the 2s and 3s, where we're phenomenal. I mean,
right.
I have a 3% mortgage on my house right now, and I love it. So I get it. Yep. But realistically speaking, I mean, I have clients that locked in at 3, 3.25, 2, whatever the case may be. And they now are very hesitant to move because it's like, why would I move if I'm locked in that low? So the sweet spot of that, we'll say high 4 range, really is the sweet spot, because if we go into the 5s, it's okay, I can still move. It's not that big of a difference. If it comes down to the low 4s, okay, I'm going to save a little bit of money and I can move as well. So it's just being able to open up more opportunity from an existing home standpoint, as opposed to just everybody converting their property to investment properties because it's like, oh, I have 3%.
What are you having any conversations with buyers, maybe their first time, where they're like, should I just wait another year? Because if you're saying the sweet spot might be in 12 months, at least I know from my perspective, it's almost like a double-edged sword, right? Like, you can wait, but there's also historically a cost of waiting in terms of homes will continue to appreciate. And so maybe what they could afford now might be a little bit just in terms of appreciation might be different. Now, interest rates obviously can play into that, but are you having those conversations at all with people as to like whether they should maybe wait 12 months or yeah, see what happens now kind of thing?
Yeah, I definitely am. I think, at least in my mind, part of that question goes into what's your plan for the future, right? Mm-hmm. Like, if you're like, I don't really know if I want to stay in Middle Tennessee, or I don't know if, I want to just try this out. I really like Brentwood, but maybe I want to be in Franklin, or maybe I want to be in Nashville. Like, you don't know the exact location. Then maybe it makes sense to wait it out a year, rent, figure out where you want to be, or, if you're going to relocate jobs, okay, I get that. That would make 100% sense. Yep. I totally understand. To me, if you're in a position to where, I'm going to live in Middle Tennessee for 5 years at a minimum, maybe longer than that, hopefully forever, whatever the case may be. At that point, I think you're running more of a risk waiting it out than trying to wait for an interest rate. And the reason I say that is kind of 2 things, 3 things, I guess. Appreciation, home value when you actually go to buy, and then interest rate is still a question mark. I know I say 12 months from now, I anticipate them to be in that range, but I am also human. I also don't know. No one is going to know that for certainty.
You don't have the crystal ball to know exactly what it's going to be.
Exactly. Yeah. I mean, obviously, I hope, I wish, fingers crossed, I'd love that for my clients. I hope that does happen. Yeah. But I mean, again, if a client asked me 6 months ago where the rate's going to be today, I would have probably been wrong, because I would have thought that they would be a little bit lower than they are today. So again, there's always that kind of like uncertainty piece. And one of the best ways to build wealth is through homeownership. I think I read a statistic or heard a statistic a little bit ago, and it said by the time you're 65. If you've never owned a home, the average person has about $10,000 in their bank account. But if you have owned a home, you have over $200,000 in equity. So like, that's just a very quick and simple, easy example to like understand that you're building wealth by purchasing a home.
Oh,
You're
absolutely.
not thinking of it as, what am I going to do today to save myself $1 today? It's more like, I'm buying this house to pre-plan for the future is how I look at it.
Yeah, I mean, speaking of that statistic, I mean, I have clients that purchased 2 years ago in Franklin, and they're sitting on about 200,000 in equity right now. That's how much our market has changed in 2 years. You know, I don't know like necessarily your perspective, and I'd love for you to share it, but I mean, I know at the beginning of 2020, before everything went wild, like we didn't know what was coming down the road 3 months after the start of the year, let alone the pickup in the market that was just, you know, about 2 weeks, or not 2 weeks, about 6 weeks later, our market picked up, and it just, I mean, we went on a real wild ride for about 2 years. So, you know, you just never know. But I mean, it's kind of like there's outside factors, right, that we don't know.
You can never know, never see. I mean, I think right now, the Fed really has their finger on the pulse as far as where our national housing market is right now. So there's that piece. I mean, COVID is a great example. I think when COVID hit, I think it was February, March, roughly time frame.
Yeah.
I would say for a month, maybe 2 months, everybody was scared, like, what's going to happen in the world? What's going to happen? I mean, like, now looking back on it, can you imagine if, while everybody else is scared, I went out and bought a property or 2 properties or 3 properties? I mean, I would have doubled my property value in a year. I mean, that's really what our market did.
Oh, it is.
It's opportunities of fear can oftentimes build absorbent amounts of wealth.
Oh, absolutely. And I mean, it's, you know, even the equity that we're sitting on, we're just kind of like, well, I mean, I remember at the peak of our market, of like the white hot market that we saw, I mean, I literally felt like I was sitting on gold, because the housing, like the inventory was so low, and you had like 30, 40 offers going on every single house. I'm like, just to have a house is gold. Like,
yeah, it blew my mind when people were putting in offers on properties that they've never actually seen. And when I say it blew my mind, it was almost one of those things that was like there for a week, and then you just get used to it, because then everybody had to do that. It's like you never had an opportunity to see a property if you wanted to buy it during that time. And to me, it's a win right now that you actually can take the time to look at the property and make sure that you as a buyer are getting everything that you want out of it. Again, I even feel like that's changing a little bit. I've heard of multiple clients in multiple offer situations right now.
They've started to come back.
Yeah, they've started to come back. So it's kind of like, you know, that's again what clients in January and February that wanted to wait till now might be facing that issue. And now I'm having to be in a multiple offer situation. And what am I going to do now?
So I know that we talked a little bit before we jumped on, but in terms of just what are some commonalities that you're hearing of the different clients that you're working with, in terms of just like what are their priorities? What are they, you know, and I know that, you know, you're having a lot of conversations, but are there any commonalities that you're finding in terms of what those buyers are deeming important right now, especially when they're going through the lending process?
Yeah, I would say one of the most common that comes to my mind, which I would say is the most common regardless of the market that you're in, regardless of the time that you're in, is people converting from being a renter to being a buyer. And the funny thing is, in almost every scenario right now, they will be paying a little bit more on their mortgage payment than they were paying in rent. But it's very easy for them to comprehend why this is the best decision, because I mean, I can think of 2 people right now that their rents increased by 7 or 8% just in the past like 6 months.
Yep.
And so, you know, it's kind of one of those things where it's writing on the wall, you know, that's going to continue to increase, and they have zero control over it. Where yeah, I can pay an extra 100 to, I don't even know, $400 a month, let's just say, as an example, on my mortgage payment. But I know it's going to be fixed for that. And, honestly, if rates come down, I can even drop that payment down. So I'm really kind of setting myself up better long-term than I am by just continuing to rent. So that's a big one right now. Probably have most of my clients are those kind of conversion situations. The other ones are a lot of upgrades. So like, I bought a house in 2020, I'm sitting on a lot of equity, or, we now have a new kid, or we want to change school districts, or whatever the case may be. And then they're kind of needing to relocate or find a new house, a bigger house, something like that. And that one, again, to me is pretty straightforward. The numbers are more important, very important to them in that situation, because it's oftentimes difficult to grasp, hey, I'm paying X at 3% on this mortgage, but then now this mortgage is going to be Y. So like understanding that context. But again, people don't buy a house because of what their mortgage payment is. People buy a house for an internal motivational factor. Like, they need a third bedroom for their child that they're about to have. They need to be in this school district so their kids can have the best education possible. Right. Those things aren't going to go away. Regardless of what your interest rate is, regardless of what the home price is, those are the things that drive you to buy real estate a lot of times. Unless you're an investor, and don't have an investor under contract right now.
But still, I mean, that is something that we're finding, especially, people are trying to determine, well, do we rent or go ahead and buy? Because, the interest rates have kind of moved along, especially in about, I guess, the last year or so now. And so, it's just trying to say, because one thing that we continue to have conversations around is basically, what's happening in the Nashville market. What do you think is going to be coming down the road, right? Because you can have a lot of noise on the national level in terms of what's happening on a national real estate market scale. But I know that for us, real estate in general is hyper local. Real estate, what can be happening like in Mount Juliet isn't necessarily happening in Franklin, or things like that. Even neighborhood to neighborhood can vary. So, we're having those conversations as well in terms of if they're moving here, kind of like you were saying earlier, for a long-term purpose, okay, if you want to rent for a little while to figure out where you want to be, that's one thing. But our market's going to continue, at least in my opinion, from what I see. I feel like Nashville in general is still on an upward trajectory. And so what home prices could be in a year from now, are homes necessarily going to jump 200,000 like they did a couple years ago? Probably not. But, at least, the way that we're reading statistics on the the realtor side of things, I think we're still going to be moving in an upward trajectory. And so, I still think it's a great time to get in, even with the interest rates, and then ride up the appreciation.
Absolutely. I would agree with that. I think the biggest thing that some people don't take into consideration is what ultimately drives home prices, and it's demand. And to me, you can look at, you can probably Google Nashville and you're going to see all these incredible statistics. We have one of the largest tech companies coming to Nashville. I just saw something last week that we have now passed Las Vegas for bachelor and bachelorette trips. Everyone wants to come to Nashville now. It's the tourism piece has just grown exponentially. We still don't have enough housing. I saw today, we have 2.6 months worth of inventory. We need to be 4 to 5 to be in a really healthy market. So, all of those pieces show that there's just so much want to be in Middle Tennessee. And whether you buy today or buy in a year, that want's always going to be there, which means the demand's always going to be there, which means the home prices are always going to be there and continue to increase. I think what sways people away are the headlines of like, oh, home prices have dropped 4.5%. I actually just Googled that a second ago, and that was the first thing I saw. But if you read into it, first of all, it's a national average. So
Yep.
you're looking at markets that don't compare to Nashville or Middle Tennessee. So that's one
Right.
piece of it. And then two, they might be decreasing, but this is my personal belief. This is no statistic based, but my personal belief is I think a lot of sellers and seller agents were getting greedy based off of COVID and did not know how to price a home effectively. So then they're having to drop their prices to get into a realistic realm of what that house is worth. And so now you're seeing those price drops, but it's not really losing value. It's just really coming to a realistic value.
Exactly. And that's actually something that I try to explain to people. It's like the market dictated X value, but when we were in the peak of our market and home prices were going exceedingly over, it wasn't necessarily the market owning that piece of it so much as it was the buyer owning it. Like the market was like, here's this, and the buyers were like, well, we'll do this because we want the house because, you know, demand is so high and inventory is so low. And now it's really our market in terms of pricing correcting itself. It's kind of like the buyers don't have to do this. So now it's coming back down to reality of where, you know, where prices should have been, because I'll agree. I mean, really at the peak, I feel like a seller could like slap a number on the house and somebody would be like sold. Like, I mean, it was wild to watch what happened.
Yeah, it really was. And I think what's crazy to me too is a little bit of a comparison to COVID right now. Like I think people are scared about what's going to happen in the future. Like, oh, is my house going to depreciate? Am I going to lose value? But then on the flip side, like, can you imagine the people that, like, people during COVID were paying $50,000 and $100,000 and $150,000 over the contract price and over the appraised value. So these people are willing to pay hundreds of thousands of dollars over what stats say that home is worth, and they felt it was a good investment. But now we're a little scared right now because of what might happen in the future to drop a little bit of value. So it's kind of interesting to me that we're willing to take the risk early on and kind of hesitant to take the risk now.
Right? Do you, and I don't mean this in any way as like a political question. Do you foresee, knowing next year will be an election year, does that play a role in what we may or may not see happen in terms of interest rates or anything like that?
Absolutely. I think so. I think regardless, again, I'm going to say regardless of politics, whoever ends up in office, there's always some sort of effect in the economy based off of that. And I mean, mortgage is a bond, so it's always going to be affected by what goes on in the country. So there's always going to be some sort of sway in one way or another. I think it's not a drastic impact.
Okay.
It's not going to be like an earth-shattering thing to where rates just drop 0.5% or go up 0.5%. I don't think that's realistic.
Okay.
But I do think it'll have a little bit of movement. I think it might put a little bit of ripple in our tide as we are going in some sort of trend once we get there. But again, I don't think it's anything that we need to like sit back and like, oh my gosh, what's going to happen here?
And I know that we talked briefly before, but just, you know, if we didn't fully cover it, want to go back to the bank thing real quick in terms of, you know, that happened and we saw movement in terms of what was happening just in the mortgage world. And so kind of what did you see initially happen, and then kind of what have you seen in the weeks that have followed?
Yeah. So when Silicon Valley Bank went under, I think it surprised a lot of people. I think it really kind of came out of the blue. But what most people don't know is Silicon Valley Bank was massive. I think it was the 13th largest bank in the US at the time, had like 500 billion in assets, I think. Don't quote me on that one, but close to it. And was really, really large. So it brought a lot of hesitancy to our economy. I think that was like an initial thought of, oh gosh, what's going to happen to the rest of these banks? Are they going to go under too? Because again, if our banking industry goes under in America, we're in a lot of trouble.
Yep.
So we never want that to happen. But I can say when that bank did go under, the mortgage-backed securities or interest rates actually improved because the perception was the bank went under because of everything the Fed has done, all of the interest rate hikes, which has made their deposits worth less money. So when this bank went under, I think the perception was the Fed was actually going to stop with their interest rate hikes. So they basically stopped pricing those in, which actually helped interest rates. We've seen the economy kind of even out or smooth out since then. So we've gotten a little bit more stability in the market from an interest rate standpoint since then. But I think the biggest thing that we're all waiting on from a mortgage world and from an interest rate standpoint is the word that nobody ever wants to say, but recession. If anybody comes out and actually says that we are in a recession officially, that could be a turning point to actually improve interest rates. I think the hesitancy of not saying the word and just kind of like looking at all these statistics is what's kind of keeping us in a really, really volatile place, because anything that happens, we're like constantly going up and down. But once we see that, I feel like we would be on like a straight trend line.
Do you think that call will be made, or that label will be thrown out there?
I do. I've been reading a lot and watching a lot about it, trying to figure out when it will happen, and that I don't know.
Yeah.
But I read a statistic the other day, and they interviewed like 50 of the top CEOs in the US, and 39 of them said that they were bracing for a recession for this year. So that to me speaks a lot of volume. And I don't see the word recession as a scary thing at all. Again, I feel like Middle Tennessee is very, very insulated from a housing standpoint. We're still low on inventory. I think that word is only going to help us from an interest rate standpoint. It will actually get out into the economy that things are slowing down, inflation's coming down, unemployment's rising, and interest rates will start to kind of taper off once that actually does become public.
Awesome. Well, is there anything else that we didn't touch on, or any final thoughts that you have just in terms of, predictions and or what you're thinking as we look forward to almost to the second half of 2023 by now? Goodness gracious.
It's flying by, that's for sure. I would say the only thing that I feel like we didn't touch on that I think would be really advantageous for any client or any possible buyer that's listening, there's a lot of creative ways to meet your goals right now. I would say even more creative now than they kind of ever have been or ever were publicly known. Let's put it that way. I was telling you before we got on the call, April will be a great month. Probably 30% of my clients are using some sort of buy down, whether it be a 2-1 buy down or a permanent rate buy down or something to just kind of help them with their monthly payment. I think they're extremely lucrative, could be a great resource to kind of fit a client's goals and needs. And we're able to do that right now because a lot of sellers are willing to kind of give a little bit to get their house under contract and move on to the next one. So I think there's a lot of opportunity there. I would say, don't feel neglected or scared from a mortgage person or a mortgage lender just because you see the news say rates are XYZ. There's so much more that goes into it and so many alternatives and options for you that you don't even know until you talk to somebody. So having a conversation is not a bad thing.
Nope. Knowledge is power.
Yeah,
absolutely. Especially just in the market. Like I keep telling people, I'm like, please don't listen to the headlines. Like talk to me, talk to a lender, like talk to people that are actually in the market that you're targeting, because, not all of the scary headlines are going to apply to what's happening in our local market.
Yeah, that's so true.
All right, Austin. Well, thank you so much. I really appreciate it. That was lots of great information. And we will include your contact information down below so that if anyone wants to reach out and talk to you, they've got your contact.
Awesome. Thank you so much. I'm so glad to be on it.
Absolutely. Thanks, Austin. So I hope you thought that conversation was informational. I hope you thought it was helpful. Again, you're going to see headlines. There's going to be so much fear-based news out there. But my goal in doing all of this is to hopefully let you hear it from somebody else that's actually in the industry, that's actually working and can see and knows. Because here's one thing about the mortgage world. There are so many statistics and bars and graphs and all of this stuff that they follow, that they watch, that they monitor, and they can kind of see based on history, certain patterns emerge. And so these are people that are within the mortgage world. And so, you know, they're giving their best predictions. Again, none of us have a crystal ball. None of us know exactly what's going to happen. But again, in trying to really combat what all of the fear-based news is, you know, I felt like Austin and I had a great conversation in terms of just what is happening, what kind of impact did that have, how it's impacted his business, and just what he's predicting for the future. So I hope you found this information helpful. If you're interested in making a move to the Middle Tennessee area, please do not hesitate to reach out to me. All of my contact information is below. My name is Caitlin Merton. I'll see you next time.